Hi, it's Jonathan Castelyn, co-head of financials research here at Hedgeye Risk Management, here with the sector head of financials, Josh Steiner. So Josh made a move today on his best ideas list, taking Bank of America off his best ideas list as a long. So Josh, I'd like to, if you could walk us through the story as to why you did that and the story behind BofA to begin with.
Yeah, absolutely. So look, this is a name we've actually had on the best ideas list for a really long time. We actually first turned bullish on BofA in early 2012 after spending just about all of 2011 very bearish. And there were a couple of macro reasons why we first turned bullish back in 2012. One had to do with them sort of finally getting a lid on their mortgage exposure from the old Countrywide acquisition. And the other reason had to do with European macro risk really starting to go the other way. The ECB rolled out its LTRO program, and that put a lot of the counterparty risk back in the bottle, so to speak.
Yeah. So what price did you put it on the list?
Yeah, actually, in early 2012, when we first got bullish, the stock was right around $7.
Right.
In early 2013 is when Hedgeye rolled out the sort of best ideas product. Right. And at that time, we added it formally, and it was around $11 a share.
Yeah. So at 17 today, obviously a great call. There were 3 or 4 things you cited in your note this morning. What exactly were the 3 issues you saw in the stock currently?
Yeah, so after a pretty long run, it seemed like now was the right time to take it off and look elsewhere for good long ideas. There are 3 main reasons. One is that the earnings power of the company, just I call it waiting for Godot. It seems like every quarter there's some new charge, some new reason why it's going to take just a little bit longer. And the reality is, if you look at some of the core metrics, if you look, for instance, at the trend in net interest income, the trend in non-interest income, the trend in earnings per share, basically what's happening is revenue's been coming down gradually over the last year and a half, largely due to rate pressures in the rate environment. Meanwhile, non-interest expenses have been going up.
Right.
So obviously, we know what that does to earnings.
Yep.
And the second reason we took it off really had to do with something we call beta renormalization,
right,
which is sort of a term we made up, but essentially what it means is that the beta on BofA back a year and a half ago was up around 2. And our argument was that because BofA holds more capital than they've really held at any time in the past, that the market would take that beta down steadily over time. And in fact, it has come down from 2 to about 1.25.
Right.
And we argued that as beta came down, the price to tangible book multiple would go up because ultimately EVA, or economic value added, is going up. And in fact, the price to tangible has gone from about 0.9 to 1.2. So about a 35% increase in the multiple alongside growth in tangible. So that thesis played out very well, but the reality is that now with beta down to 1.25, there's really not a lot of juice left there. Yep. And then the final reason we took it off essentially had to do with valuation. When we first put it on, BofA, relative to the group, was trading at a large intrinsic discount to fair value. But today, in the note, we put up our most current and most recent updated look at valuation, and it's just about fairly valued. It looks like it has about 2% upside to fair value. Yep. Based on our recent screens. So those are the main reasons why we took it off.
Yep. So no replacement name today for the long on Bank of America, but it still sounds like Capital One would be your best idea now at this point?
Yeah, Capital One's a name that we've been bullish on here since the beginning of February 2014. Initially, it was really sort of looked at as a 6-month trade. Yep. Based on this idea that just about every year Capital One misses fourth quarter earnings in mid-January and then really knocks it out of the park when they report first quarter earnings in mid-April. So that generally gives you about a 6-month long trade. And then we actually extended the thesis when we started to see loan growth start to pick up meaningfully in the card space. So that positive fundamental dynamic, coupled with the fact that Capital One is very cheap intrinsically. So yeah, that's our favorite name on the long side.
And what do you think it's worth, Capital One?
Yeah, so we think upside in Capital One from this valuation is probably around 20% over the next 6 to 12 months.
Okay, great. So Josh has moved off of his Bank of America call, been a wonderful call for the firm, put it on at $7, now moving off of it at $17, prefers Capital One at this level. I'm on the asset management side. I still like Legg Mason and Ox Ziflong, and this is Jonathan Castelyn from Hedgeye. Please follow us on Twitter. I'm at HedgeyeJC, Josh at HedgeyeFig. Thank you very much.